Bitcoin is sitting at a key level of $59,000, and within the past couple weeks, it has dropped as low as $53,000. This is the perfect time, in my personal opinion, to be accumulating Bitcoin. And that could be from dollar cost averaging your capital into Bitcoin, or that can be using liquidity mining and yield farming. Now, today I'm going to be showing you exactly you can be earning 40% APR on Bitcoin. And the reason why you might want to earn 40% APR on Bitcoin is so you can further diversify your exposure. Let's just say you have one Bitcoin right now and you're running a 40% APR strategy over the course of a year. The goal is that one Bitcoin would then translate into 1.4 Bitcoin after the time span of a year, because you increased your overall holdings. Which means if Bitcoin is at, let's just say $50,000 and you have one Bitcoin right now, you have $50,000. But then of course, Bitcoin goes to $100,000. And then of course you have 1.4 Bitcoin as well. You now went from 50K to 140,000 instead of 50K to 100,000. So you have an extra $40,000, an extra 40% right there. A lot of people fail to realize that your cryptocurrency assets are inflationary as well. Currently, Bitcoin has a circulating supply of 19.7 million. Its total supply, its max supply, is 21 million tokens. Ethereum has an infinite total supply, although Ethereum has some pretty good deflationary measures in it. Solana has an infinite total supply as well. So it's just important to not only look at the US dollar inflation as well as other fiat currency inflation, but also cryptocurrency inflation and different methods of combating that. Now, if you're like me, you probably look for blue chip strategies all the time. And when we look over on DeFi Llama, we see some of these pools with TVL as low as $18,000, showcasing a 740% APY. But when we dive into this APY chart, you can see that there is just a small sliver period where it's a super high APY, and the rest of the time it's averaging roughly 1 to 2% per year. So obviously not too good. What I like to do is I like to go to APY and I like to look at a minimum of 10%. I like to go to TVL and look at a minimum of $1 million. The reason why is because I don't want to be looking at strategies that have super low TVL that might end up making me exit liquidity, where people can just dump their tokens on me and I'm stuck holding them basically. Now also remember that there's not much that we can do with native Bitcoin. We're going to have to use a derivative of Bitcoin, something like Bitcoin B, which represents Bitcoin bridged, or Bitcoin B over the Binance network, which is Bitcoin Binance. It's facilitated by Binance, or of course wrapped Bitcoin. Now of course I do notice a lot of opportunities when putting these filters, this TVL as well as APY. There are 29 different pools right here. I'm gonna go ahead and up that TVL to something like $2.5 million just so I can get down to 13 pools. And still, we have some really good high performing opportunities, and we also have some of the ones that are around 10%. Now what I can do here is I could look for pools that have Bitcoin along with the correlated asset or Bitcoin along with a stablecoin. And the reason why I want to do that is because with Bitcoin and a stablecoin, I can dollar cost average into Bitcoin on the way down. Whereas with Bitcoin and a correlated asset, essentially whenever Bitcoin goes up and Ethereum goes up, let's just say, because Ethereum is pretty correlated to Bitcoin, whenever those assets are rising, I'm making money and I have full market exposure. I'm not going to have a ton of divergence loss because those assets are correlated and there's not much divergence between the two. So off the bat, I see Bitcoin to USDC over on Merkle on the Arbitrum chain. I also see Bitcoin to ETH on the Arbitrum chain with $34 million in TVL. This is showcasing an 144% APY, and we can keep on going down this list. Now I know that Merkle is a yield optimizer where basically you can earn on top of your already existing concentrated liquidity opportunities. So if I go ahead and pull up this pool over here on Merkle, let's just say, we'll type in wrap Bitcoin, and then we will go and we will sort the chain, which is Arbitrum. Now it's showing a 144% APR, but remember, we have to take into account that's assuming that we have a relatively tight range. Now the best part is this position is on Uniswap V3. It's providing additional incentives through ARB tokens basically by being over on Merkle, because Merkle facilitates reward tokens. There's also the wrap Bitcoin to USDC one over here. So now that I know which pools these actually are, I can head into Metrics Finance, which is a software that allows you to simulate potential returns of a liquidity pool. Now what we're going to be using on Metrics Finance today is 100% free, and do keep in mind that Metrics Finance does not factor in Merkle rewards. It only factors in the fees that you'll actually get for liquidity mining on this position. Now, as far as my deposit goes, I'm just going to place it at roughly $10,000. That's something that I would be comfortable deploying into this pool. And then as far as the range goes, I can do something like 20.5 to 23.9. That's going to be a good range if I want to weight a little bit more towards Ethereum, because I think Ethereum can do better. But remember, we're trying to earn income on Bitcoin. So what we'd want to do is we'd actually want to broaden our range to the upside, do something like 24.2, and then bring that min price down. So that way we could weight a little bit more towards 50-50 or even a little bit more towards Bitcoin itself. And just like that, a range of 21.3 to 24.3 is going to get us roughly a 39% APR. That's going to weight us to roughly 52% in Bitcoin and 48% in Ethereum. Now, do keep in mind this is a relatively tight range, and as the price chops up and chops down, ultimately what's going to happen is we're going to be shifted from Bitcoin into Ethereum or from Ethereum into Bitcoin. And remember, this 40% that we're getting right here, this APR, does not even factor in the Merkle rewards that we're going to get on top of it. And these Merkle rewards could be an extra 20%, 30%, or they can be an extra 50, 60, 70%. Just keep that in mind. It's going to depend on your range as well as the other liquidity providers in the liquidity pool. So that's one option that you could do right there to earn a 40% APR on your Bitcoin, pairing it with a correlated asset like Ethereum. The next option, which in my opinion is going to be relatively risky in a sense, but it's not too risky. It's essentially using leverage. Now, this is a good strategy if you are long on Bitcoin and you are willing to take on some risk. And basically what you would do within this strategy is you would go and collateralize wrap Bitcoin over on OV. The thing is, collateralizing wrap Bitcoin on OV gets you 0.08%. And the reason why I say OV is because OV is the top lending market out there. It currently has a TVL of roughly $11.5 billion right now. Keep in mind, DeFi's overall TVL is roughly $84 billion. So it makes up for a big portion of that. There's a lot of liquidity over on OV. But basically, if you put your Bitcoin here, let's just say you were to put $100,000 of Bitcoin on OV, and then you were to borrow stable coins, let's just say. So you borrow this USDC right here, and then you use that USDC and you actually go and buy some Bitcoin, but keep some of the USDC, and then enter into the wrap Bitcoin to USDC liquidity pool. Now remember, we could do this over on Arbitrum Network, or we could do it on any network. I'm just going to show it to you over on Arbitrum Network because it does have a decent return over there because of the Merkle rewards. Just remember, if we're putting $100,000 of Bitcoin over on OV, we're probably going to want to borrow around $40,000 of Bitcoin in the sense where Bitcoin continues to decline as it is right now, and then we want to prevent ourselves from liquidation. And then if we were to do a broader range of, let's just say, roughly $70,000, and then we're to put our min price at something like $55,000, you can see that gets us roughly 70% Bitcoin and 30% USDC. Now the benefit of this pool is if Bitcoin starts to rise, our collateral right here, this wrap Bitcoin that we have, will rise and we'll make all the returns right there. But remember, we have a $40,000 borrow that we have to pay back in order to get that initial Bitcoin back. But the thing is, we would borrow stable coins. So that means that our stable coins are not going to rise other than the fact that we have to pay like a 5% APY to borrow those stable coins. And then of course, over on this wrap Bitcoin USDC strategy that we're running, as Bitcoin rises, we are being sold out of Bitcoin into USDC, but we're still making money from price appreciation, but also the APR. The APR right here being 90%. And if we were to slice that in half, we would get roughly 45%. Now, why exactly would we want to slice it in half? That's simply because remember, we are putting up roughly $100,000 of Bitcoin as our supply, but then borrowing roughly $40,000, $50,000 on our borrow. So effectively on our initial $100,000, if we're making $36,000 a year, that's roughly a 36% APR on our $100,000. But keep in mind, we also have those Merkle rewards over here, which is showing roughly a 159% APR. And keep in mind, that could be relatively low, that could be relatively high. It really just depends on where other liquidity providers have placed their liquidity. Or the other simple thing that you could do is just take your Bitcoin and park it in something like wrap Bitcoin to USDC. This is great if you think that the market is going to chop sideways and just move sideways for a decent period of time. And the reason why is because remember, as the price moves up, your Bitcoin is sold into USDC. As the price moves down though, your USDC is being sold into wrap Bitcoin. So if you're neutral on the market right now or bearish in the market, wrap Bitcoin to USDC could be a good opportunity. I will say if you are bearish in the market, you're probably going to want to do a range of roughly 63,000 on the top and then maybe like 52,000 on the bottom. The reason why is because that puts you at 65% USDC. It gives you more USDC to buy up Bitcoin on the way down. And if you want to buy it up over a longer period of time, you can broaden that range to like 50,000, 63,000. That will get you like 73% USDC. Or if you're neutral on the market, literally just weight it more towards like 50-50 because that's the best thing that you could do when you are neutral on the market. Over the past 30 days, Bitcoin has consolidated between 54,000 and 64,000. And as you can see, we would have got roughly 125% APR if we were just using this range over the past 30 days. So that comes out to roughly 10% a month. We would have made 10% on our Bitcoin basically. It's just all about getting in the market and having that time in the market. So guys, I encourage you to go practice what I just did over on DeFi Llama, as well as practice what I just did over on Metrics Finance. Remember, we're strictly using stuff from the Metrics free version in this video. So you don't have to go pay for it. You don't even have to create an account if you don't want to. Now remember, whenever you enter a position, you're automatically getting rewards over for Merkle just by being in that position. So always make sure to check your Merkle dashboard to see what rewards you have to claim. As you can see, I have $23 right here to claim that I didn't even know about beforehand. Anyways, that wraps up this video. If you enjoyed, drop a like, subscribe with notifications turned on, and I'll see you guys in the next video. Peace out.